We look at the numbers, the market's going to be a little bit disappointed with this negative jaws in 2018. Where were the worst pockets of turbulence for you in the fourth quarter as we closed out the year?
Yeah, so, Manus, we very much expected to get to positive jaws for the year when we got to the end of third quarter. I think what happened in Q4 was a very significant market downturn in November and December. What you saw were revenues came in at just over $1 billion less than a very strong Q3. Most of that was very much related to markets, weakness in our global markets operation. Revenues were down 39% compared to Q3. And we also saw softness in markets-related revenues in our insurance manufacturing business as well. Costs actually very much in line with what we thought they would be. So the big miss on jaws was a revenue miss because of weak markets in Q4.
Has there been any pickup in revenue as we go into the start of 2019? Any reprieve that you can tell us of?
No, January was good for us, actually ahead of plan. So we were pleased with the start to the year. I think we're a bit more cautious as we look out, but so far, January very much on track.
OK, let's deal with the jaws. Last year, the market thought you'd make a positive number around 5%. They trimmed that back to a consensus, maybe of around, I'd say, 2 to 3. What can you guide the market for 2019? What is deliverable? You say positive, but where can it get to? 2%?
Look, I'm not going to give you actual numbers. Both John and I really like the discipline of jaws as a metric to manage to internally. I think underlying our cost growth at the moment, important to remember, we're in the middle of a very substantive investment program. We grew investment spend by 10% last year. We intend to grow it again this year. Big investment into growth and big investment into digital transformation. But we do expect and continue to commit to achieving positive jaws.
To achieve that positive jaws, one or two people have said to me, look, you might have to readdress that investment commitment that you made last summer, the $15 to $18 billion. Is that safe? Is that intact? There's no reduction in that.
I think we're already being a little bit more cautious as we look out for the year. We have slowed some of that investment spend down. We've slowed some of our investment into headcount growth down. I think we'll continue to be cautious until we see how the revenue environment plays out this year. And it is a particularly volatile revenue outlook as we look at the year, particularly around the UK and to a lesser extent with the US-China trade discussions.
Which of those worries you the most, Ewen? Because you're ring-fenced in the UK. So tell me, I suppose you're the gateway into the soul of China. Let's deal with that first of all. How did the China slowdown manifest itself in your numbers?
It's very hard actually to see that at all in our 2018 numbers. We had revenue growth here in Hong Kong of 14%, 14% in mainland China, and our international customer revenues were up 7% for the year. I think where we are seeing some credit softness is in the UK, and I think the UK is the market I'd be more concerned about at the moment than Hong Kong and China.
OK, I mean, you've got capital to deploy in the UK. I'm told that you're aggressively trying to grow market share. Is that proving hard in the current environment? How's it stacking up in the UK?
No, the team did a great job there last year. Revenues were up 7% in the UK. We had mortgage growth at 10%. We took another 50 basis points of market share in the mortgage market. So we're certainly able to take the share we wanted to take at the moment, and we're certainly able to grow our UK business. I think we're just cautious on the outlook for credit, given the lack of certainty on the direction of the UK economy.
Ewen, what have you and the board discussed on the preparedness for a hard Brexit? What is the discussion inside your boardroom?
Oh, you should assume, Manus, we've been working on this for years now. We've got the benefit of a big operation in France that we've had for a long time. So for us, it is easier than some of our domestic UK peers to prepare for Brexit. On my side, capital, funding, liquidity ratios, all very strong. And you would have seen today in today's results that we've taken some additional provision for the uncertain economic outlook in the UK.
Can I pivot back to the shareholder? We're focused on jaws, we're focused on return on equity, but we're also, this line that Mr. Flint used, remaining committed to the share buyback. Now, the market's going to want a little bit of guidance. I've seen a load of notes that the buybacks could be trimmed back. What's reasonable to assume in buybacks from HSBC going forward?
So what we've committed to is to neutralise any scrip take-up in our dividend. So today we declared a final dividend of 21 cents, a full-year dividend of 51 cents, in line with what we paid last year. We've committed to scrip neutralisation of that, but I do think we're going to be cautious on buybacks in the very near term until we have a better sense of direction of travel in the UK and a better sense of direction in terms of the China-US discussions.
Now, obviously, central bank rates are critical to you. You're very geared to the net interest margin story in terms of dollars. The Fed pivots to pause. Is we going to expect, I suppose, a net interest margin headwind for you? Are we at the top of that rate cycle globally?
We can still see some benefit coming through from the rate rises we had in 18. We expect some, but more modest rate rises into 19. Actually, if you look at net interest income last year, the biggest driver of net interest income growth was the underlying growth that we're getting through our loan portfolios. Average interest earning assets were up 7% last year, and that was the core driver of net interest income growth.
Ewen, do you think that we could get a rate cut quicker from the Fed in 2020 or the PBOC in 2019? What do you reckon?
Yeah, I'm not going to speculate on when we may see rate rises or rate cuts. I do think that our underlying businesses will just be responsive to whatever we see coming out.
Obviously, in China, we are sort of obsessed, I suppose, about credit quality and defaults. I mean, when do you consider slowing down your China growth because you're concerned about credit quality, or are you not concerned about credit quality in China?
Yeah, I mean, if you look at where our big exposure is in Asia, it's actually here in Hong Kong. I think we're very comfortable with credit exposure in the UK, in Hong Kong. The average LTV of our mortgage book is 42%. The average LTV of our new mortgages last year was 48%. And in China, I think, particularly in the Greater Bay Area, which is mainly where we're concentrated, we're seeing continuing good economic growth.
Can we just finally discuss the uber wealthy and the wealth management division? I think, you know, UBS had money pulled out with one or two people saying, look, the wealth management areas in their business froze. Was there a palpable slowdown in wealth management, and has there been any reprieve in these first sort of 30, 40 days of 2019?
Yeah, what we saw in sort of insurance manufacturing or wealth management business in Q4 was very much a sort of markets impact in terms of the revenues. Underlying customer flows continue to be pretty robust. If you move across into our private bank, actually very encouraged by the potential of that business, both in terms of profit growth and return growth. Yeah, we do see a huge opportunity here in Asia to build a very strong wealth franchise over time.